So what is the GDP or gross domestic product? In this video I will explain you exactly what means the GDP or gross domestic product, and then you can use this data in your trade. It's very easy, but you should very be careful when you trade in the market as like crypto, stock, or in Forex. You should use this data on your trade because it's much easier when you know this data. But I'm here to tell you about the GDP, and let's go to see what means the GDP or gross domestic product. So let's see what means the GDP or gross domestic product. The GDP is the total monetary of the market value of all the finished goods and services produced within the country borders in a specific time period. As a broad measure of the overall domestic production, is a function as the comprehensive scorecard of the given country economic health. So GDP is typically calculated on the annual basis. It's sometimes calculated on the quarterly basis as well. In the US, for example, the government released an analyzed GDP statement for each fiscal quarter and also for calendar year. The individual data sets included this report are given in the real terms. So data is adjusted for price change and is therefore the net of the inflation. The calculation of the country's GDP encompasses all private and public consumption, government outlets, investments, addition to private inventories, paid in construction costs, and the foreign balance of the trade. All of the components that make a country's GDP, the foreign balance of the trade is especially important. The GDP of the country tends to increase when the total value of the goods and services that domestic producers sell to foreign countries exceeds the total value of the foreign goods and services that domestic consumer buy. When this situation occurs, a country state have a trade surplus. If the opposite situation occurs, if the amount the domestic consumer spend of the foreign product is greater than the total sum of the domestic producers are able to sell to foreign consumers, and is called trade deficit. So in this situation, the GDP of the country tends to decrease. GDP can be computed on the nominal basis or real basis, the latter accounting for inflation. Overall, the real GDP is better method for expression long-term national economic performance since it's use constant dollars. So let's say one country had a nominal GDP of the 100 billion in 2012. By 2022, its nominal GDP grew to 150 billion. Price also rose by 100% over the same period. In this example, if you look at slowly at the nominal GDP, the country's economy appears to performing well. However, the real GDP would only be $75 billion, revealing that overall decline in the real economic performance actually occurring during this time. So in this picture, you can see the US GDP over the past 15 years. You can see in 2008, the maximum was around between $1,400 billion. But in 2022, it was around between $26 billion. So you can see what's the difference between the GDP and how it is increasing during the long term. So that was the example for US GDP over the past 15 years. So let's see what means the nominal GDP. The nominal GDP is an assessment of economic production in an economy that includes current price in this calculation. In other words, it doesn't strip out inflation of the piece of the rising price, which can inflate the growth figure. All goods and services counted in nominal GDP are valued at the prices that those goods and services are actually sold for in that year. Nominal GDP is evaluated in either the local currency or US dollars. at the currency market exchange rates to compare the country's GDPs in purely inflation terms. Nominal GDP is used when comparing different quarters of the output within the same year. When comparing the GDP of the 2 or more years, real GDP is used. This because in effect the removal of the influence of inflation allow to comparison of the different years to focus on slowly on the volume. So the last part is called real GDP. Real GDP is an inflation adjusted measure that reflects to the number of goods and services produced by an economy in given a year, with the price held constant from year to year. Separate out the impact of inflation or deflation from the trend in output over time. Since GDP is based off the monetary value of the goods and services, is subject to inflation. Rising prices tend to increase the country's GDP, but this is not necessarily reflect any change in the quantity of or quality of the goods and services produced. Thus, by looking just an economy nominal GDP, it can be difficult to tell whether the figure has risen because of the real expansion in production or simply because prices rose. Economists use a process that adjusts for inflation to arrive at economy's real GDP. By adjusting the output in any given year for the price levels that private in the reference year, call it the base year. Economists can adjust for inflation impact. This way it's possible to compare a country's GDP from one year to another and see if there is any real growth. Real GDP is calculated using a GDP price deflector, which is the difference in price between the current year and the base year. For example, if prices rose by 5% since the base year, the deflector would be 1.05. Nominal GDP is divided by this deflector. Nominal GDP is usually higher than real GDP because inflation is typically a positive number. Real GDP accounts for change in the market value and thus narrows of the difference between output figures from year to year. If there is a large discrepancy between a nation's real GDP and nominal GDP, this may be an indicator of the significant inflation or deflation in economy. So if you like this kind of the information like GDP, CPI, PPI, and all information about the market like crypto, Forex or stock, I will tell you in this channel, so you can just subscribe to the channel and then join, because every time when I upload a new video, so you can see all the content. So just make sure to subscribe and also click on the bell and then you get notified. So when I upload the new video, so you can see. So that was all guys. And also I made one video about the CPI and PPI. So you can just click right here and then you can see at what mean the CPI and PPI, which is also important when you trade in markets. So that was all about the GDP or gross domestic product. And thank you for watching, and remember to also see the CPI and PPI, which is also important. Thank you guys and have a nice day.